Hey, I'm Dan Fitzpatrick at Stock Market Mentor. If you want to basically have a guarantee of profit in 2025, here's 10 trading rules that you have to follow. These rules apply irrespective of whether you're trading for a lifetime hold or micro trading and day trading. These rules are really inviolable for any kind of successful trading. You just kind of want to treat it as a business. If you can think of your trading as a business as opposed to just having fun slinging stocks and options around, you're going to succeed by following these rules. The first thing is I want you to be able to define an acceptable dollar and percentage amount on each trade that you're risking. In other words, you need to build in like a worst case, oh crap, I'm wrong scenario before you make the trade, because after you're in the trade, you're in it. I mean, now it's subjective. It's no longer objective. It's no longer math. Now it's, am I right or am I wrong? And oh my gosh, I don't want to lose money, so I need to hold on to this, or should I average down, or any of that other crap, okay? You don't want to be messing around with that. And so the way you do it is you decide, where is my entry? We'll get to that later too. But where is my entry, and then where is my stop? Where do I put my stop? I put it right at that level where if that stock hits that stop, I have to conclude that I'm wrong. If I'm buying a dip that's really just starting to bounce, then I put my stop just a little bit below the bottom of the bounce. Why? Because if the stock falls again below that bounce, well, guess what? It didn't bounce. It's just on the way down lower. Similar thing with a breakout. If I'm buying a stock on a breakout, there has to be a level below the breakout where if the stock falls back and hits that level, I have to say, all right, well, this was a fake out. It's not a breakout. I missed it. The trade's not going to work. I need to get out of it. So these are things that you set before you enter a trade. And you also have to look at the dollars. It's not just percentages. In fact, percentages really don't matter at all relative to dollars. So if you have a particular portfolio size, you need to look at it and say, how many dollars am I willing to risk on any given trade? And then that's really your limit. So you use that dollar amount, and then you say, all right, well, how many shares can I buy? Keep my stop where it's supposed to be, and then still risk no more than those dollars. So this is really the first rule. And frankly, be perfectly candid with you. If you follow the other 9, but you blow this one, I can't help you out. If you follow this one, but you blow some of the other 9, at least you stay in the game and you can continue to learn and hopefully make money as well while you're ironing out all these rules. But this really comes down to deciding. And I'm not just saying, oh, you have to set a stop on every trade. Duh, you do. I'm saying, how much am I willing to risk on any given trade, and then never go beyond that? You're going to wind up doing really well. Also, know why you're buying a stock. Why am I buying? I've got over 6,000 to choose from. Why am I buying this stock above all others? And not only that, but why am I buying it now? If you don't know why you are buying a stock, then you're not going to know when to get out of it. This is really important. If I were to say, okay, you just bought XYZ. Why'd you do that? Explain that trade to me. I don't understand. You need to be able to explain that to me in bullet point format. You need to be able to tell me like what the company does, what the chart looks like, where your drop dead, oh crap, I'm wrong level is. Why exactly are you buying it right here, right now? And then you also need to define your parameters. Okay, well, yeah, I'm setting my stop here. Okay, why are you doing that? Explain to me why you're setting your stop there. Well, I'm setting it at $100 because, no, don't ever set a stop at $100. You can set it at $99.50, but never set a stop at an even figure. Never. Because a lot of times that's when the limit buy orders are, or the limit sell orders. So you don't want to have a stop right at an even figure. You need to go through the whole checklist as far as why you're buying a stock. And by the way, if you're a member of Stock Market Mentor, you know I do this. If you're not, I'm going to tell you. When I feature a trade, and we have a list of active trade ideas, I always want to give people good trades, trades that they can look at, trades that they can understand, trades that they can replicate. You know that I tell you all of these things. I can elucidate. Is that a word? If it's not, it should be. I can tell you exactly why I am featuring this stock right here, right now, where the stop is, why I'm doing it, where the entry point is, and what we should do next. Okay, I have to do that because I am a trading mentor. I got the camera on me. I got to help you out. But if you're not trading along with me, and most of you aren't, then you need to be able to do that yourself. So you got to understand why you're buying a stock. Also, I guess you could say this is part A as far as the rules go. Never buy a stock because somebody else is buying it. You look at the chucklehead on Mad Money, buy. Don't do that. In fact, crying out loud, 9 times out of 10, sell. You need to know why you're buying, and it's not because I'm buying or somebody else in our trading room or somebody on TV or somebody on YouTube or some article that you read. Oh, so-and-so's put an overweight on this stock. Big deal. Nobody cares. You shouldn't care. You need to know exactly why you're buying it, because think about it this way. If you're buying a stock, like just because I'm buying a stock, when do you know when to sell? How do you know when to sell? Do you have my cell number? You don't. What if I'm sick? What if I'm out to lunch? What if I miss a move in the stock? You don't want to rely on me to tell you when to sell a stock. Yet if you relied on me to tell you when to buy a stock, that's your exit. When does Dan say I should sell this stock? So I don't want you to do that. You need to know exactly why you're buying the stock, and the answer better not be because Jethro Stokes bought the stock or Dan Fitzpatrick bought the stock or anything else. It has to be because you know why you're buying it, okay? Enough said. Also, this gets back to stops. I've already mentioned it in passing. You need to know where that stock goes in order to prove that you're right. And by the way, you also need to know where that stock goes in order to prove you correct. If you're buying a stock, say on a breakout, well, obviously it needs to continue to go up. Maybe, and I talk about this all the time, it's in a phase 1, 2, 3 situation where you get a breakout, that's phase 1, and then a little pullback, that's phase 2. And then finally, hopefully, preferably, the stock resumes its uptrend, and that's phase 3. So you have to be able to know all of this stuff before you really start trading very frequently, or certainly in very big ways. But you have to understand these types of movements in a stock so you know when to sell and when to buy more. You have to understand the ebb and flow of the market. Also, I just saw a video of an old interview with George Soros a couple days ago, an old interview. And George Soros ain't my kind of guy, but he's a hell of a trader. He was talking about how he starts off small. You start off with a pilot position, and Jesse Livermore talked about this all the time too. You start off with a small position, and the reason is, and listen to me, I'm giving you pearls. The reason you start small is that is when you are at the greatest risk of loss, because you're putting your capital on the line. And let's face it, it's a coin flip. When you buy a stock, the stock could go up, the stock could go down. You're putting your experience, your pattern recognition, your strategies, you're putting those in play to help you with the odds of making money, but really it's still a coin flip. And so what you want to do when you first start is you want to put as little amount of capital as you can, though it needs to be high enough to where it makes a difference. So you actually pay attention to the stock. Once the stock starts moving in your favor, see, now you have some profit that you're playing with. You have some cushion. And so once you have a little bit of a cushion, then you can go through your sequence. You can go through your rotation and actually be adding to your position, because your risk of loss of your initial capital is much lower. And so you gradually build a position, and not every position. You build the positions that are confirming that you're correct on the trade. That's why you never average down. You're only increasing your positions on trades that are working. Always go in small, then go big on the ones that work. Now, you got to have reasonable expectations. And the reason why I'm saying this right now is the market's pretty heavy. It actually kind of feels like it's about to lift sometime soon. I'll just say that. I'm not looking at charts here. So the market feels pretty heavy. And what I'm seeing in our trades is they're the rebounds, the breakouts that are working, but they're not paying off the way they typically would in a stronger market. And so I look at the overall market, and I want you to be looking at this too. And you need to be tailoring your expectations to what the market's going to give you, not what you want the market to give you. Personally, I want the market to give me 1,000% return on every single trade that I make. Sadly, the market's not going to do that. The market doesn't care what I think and what I want. And I hate to tell you, it doesn't care about you either. And if it did, probably wouldn't like you, because you're trying to make money. What we want to be doing is tailoring our expectations to what the market's going to give us. And what I do, I built this app, this tool, TradeTrak, to help people not just track their trades, not just categorize your trades. You want to always be keeping track of your trades. You want to measure your trades so you know, like, okay, what's my average gain? What's my average loss? What's my batting average, et cetera, et cetera. There's 6 or 7 different metrics that you should be tracking. And by the way, if you're not doing that, check out TradeTrak.com, or you could even just look at it from my website, stockmarketmentor.com. The point is, you want to be able to know at any given time in your trading progress, what is your average gain? Like, let's say, for example, I'm digressing a bit, but let's say, for example, your average gain is 17% on a trade, and the average loss is, say, 5% on a trade. All right, so you're going to have reasonable expectations. Your expectation is, on average, on a trade that's working, your reasonable expectation is you're going to make about 17%. Once it gets to that level, then you say, all right, well, I want to keep going, but it's good that I have my reasonable expectations met. And then the stock continues to go, fine. Now you start protecting your profits on that trade so you don't fall below your average gain, which is, I would say, a reasonable expectation. Now, what happens if, as time goes on, as the days go into weeks, go into a few months, you see that your average gain is no longer 17%, maybe it's down to 15%, 10%, 8%. It's definitely a lot lower than that 17%. Here's what you don't do. You don't stick to your guns. You don't say, well, yeah, but I want to get that 17%. No, it's no longer reasonable. It's no longer reasonable to expect that. So when your trades that are working start falling as far as your average profit go, then you need to be looking at that and say, all right, I need to ratchet down my expectations because the market isn't really giving me what it used to give me. And I ain't going to argue with the market. The market determines what's right and what's wrong, and I'm going to have to roll with what the market's giving me. And the way you do that is to just have reasonable expectations. Give yourself, cut yourself some slack. Don't expect, don't ask too much from any given trade. But on the other hand, don't cut some trade off just because you had too many cups of coffee. Have your expectations reasonable and then expect those expectations to be met. Here's another thing, and this is just with respect to actual price movement. Never buy a stock that's gone up. Well, I have this 3-day rule, frankly. Never buy a stock on the 3rd day of a big advance. After 2 days, you need to stay away. And this is how it worked. On the 1st day of a big move, I look at that as the smart money. The smart money, the big money, pushed that stock that way. A bunch of institutions are grabbing the stock and it's up 5, 6, 7%. So the smart money is buying on the 1st day. The semi-smart money buys on the 2nd day. That money is not as well capitalized as the smart money. And by the way, the smart money is well capitalized because it's the smart money. So the semi-smart money kind of sees what's going on and then they plunge in, and that pushes the stock even up even more. And then finally on the 3rd day, the not so smart money, I'll even say the dumb money, sees what's going on. Saw it on the 1st day, didn't believe it. Saw it on the 2nd day, wished they got in, but instead said, you know what, if it goes up tomorrow, then I'll get in. I'll wait until the coast is clear. But by the 3rd day, what's happening? The smart money, they're not buying anymore because they bought down low. The semi-smart money, they're probably selling already. And you, on the 3rd day, you're the dumb money and you don't have much money at all. And do you know why? Because you're buying on the 3rd day. So avoid that trap. If a stock has run up for 2 days in a row, do not chase that stock. Every once in a while, chasing that stock is going to reward you. Hopefully it's not the first time. And the reason I say hopefully it's not the first time is because if you chase a stock and you make really good money the first time around, you're going to think that's a great trading strategy and you're ultimately going to quit the game. So play the odds. Know that after 2 big days, not likely to see a 3rd day until a stock pulls back a little bit. And by the way, here's the next rule. The same thing on the downside. Your rule number 8, never short a stock that's fallen for 2 days in a row. I want you to think about this. As a stock falls, just about any stock, as a stock falls in price, there are buyers underneath that stock waiting to buy that stock, waiting for the value to get right. Oh, the stock's at 150 right now, but I think the real price is 135. So if it gets down to 135, oh, that's close to the 200-day moving average, then I'll buy it. So that's like this natural floor that you don't really see, but it exists out there. I call those just phantom buyers. They're there, but you don't see them. So if a stock starts to fall a lot, for you to be shorting the stock after it's fallen, it's really not any different than chasing a stock after it's run up a lot. One of the biggest differences is there is always an underlying bid for any stock. Always an underlying bid. That's what makes a chart. And so if a stock starts to fall and keeps falling and keeps falling, if you want to sell short, if you're a short seller, or frankly, if you happen to be just like looking to buy the stock, you need to understand that at some point, that rubber band that's stretching, as the stock falls, at some point, that's going to snap back and the stock's going to recover. So you need to know where you are in the sequence. Where is the stock? Oh, it's up big 2 days in a row, or 3 days in a row, or 4 days in a row. You need to understand that, as opposed to just reflexively buying or reflexively shorting. You need to have rule. That's the bottom line. You've got to have rules. And if you are not a rules-based trader, it's only a matter of time before you're a guy that used to be trading but no longer does. One other thing, and I've alluded to it a few different times here, you want to always be buying close to support. And why is this? Because support is established. We can identify support because that's where buyers are always coming into the picture to kind of keep the stock up. They're buying here, stock falls down, and ultimately this $130, $15.50, whatever the price is, you can see it on the chart where if the stock falls to here, that's where support is. Maybe it's a moving average, maybe it's a specific price, something like that. But you want to be able to know not just where you guess support's going to be. Oh, I think stock will rebound there. You're not paid to think. You're paid to react in the right way. So once you identify support, that's kind of like, remember what I was talking about a while ago in another rule. That's where your oops, I'm wrong, oh crap, I gotta get out level is. You're buying close to support. That means if the stock rebounds, great, you get much more of the movement. But if the stock comes to support, you think it's gonna rebound, you buy it. And then that support breaks down, you're not losing that much money in order to make the conclusion that you're wrong. So if you're buying a stock that's 15% above where support is, well, think about it. Then when that stock rolls over, you got to wait 15% before you even know if you're wrong or if you're just late. If you buy the stock, say, 3% above where support is, well, I guess you got to risk about 4% to know whether you're right or wrong. Because if the stock falls through support, through your 3% risk, you're selling shortly after that. So buying close to support is a really, really key thing to do. The 10th rule. This is almost kind of, it's kind of counterintuitive, but I'm going to tell you anyway. Know when to break any of these 9 rules. And what I mean by that is there are special situations, whether it's a short squeeze. I use Bollinger Bands to look for squeezes. Say a stock's breaking out to the upside out of a really, really tight squeeze, runs right through the 3rd standard deviation, Bollinger Band on the upside, and keeps going. Oh my gosh, this has gone up 3 days in a row. Oh, Dan says I can't buy this stock. I think that was rule number 7. I can't buy this stock. You can break the rule on that one because that's a special circumstance coming out of a squeeze. And when a stock runs like that, not any stock, don't make more of this than it is, but when a stock runs up 2, 3, 4 days in a row, that's a power move out of a squeeze. Jump on board, follow the other rules as far as knowing why you're buying, knowing how much you're going to risk, things like that. But you can go ahead and break that rule in that case. But the point is, and the point I want to leave you with is this: if you are a rules-based trader, and if you go back, if you study these rules, make your own. I can't tell you exactly how much to risk on any given trade or what patterns to follow, things like that. Those are individual choices. But what I can tell you is if you follow these rules and continue to learn, by the way, you want to continue to learn and gain an experience, study, read books, take my courses or somebody else's courses who really resonates with you. But if you continue to learn and you're following these rules, look, think about it. You're going to stay in the game long enough to survive the ups and downs and the mistakes that we all make when we first start out, you're going to stay in the game long enough to get these rules down to where, frankly, you know what? You're not even thinking about them anymore. You're just doing them. That's called unconscious competence. There's 4 stages of competency. That's for a different video. I'll just tell you this. If you're doing your best to always be consistent in following rules, what you're going to find is at some point, you're going to look at any given trade, or maybe somebody's going to ask you about a particular trade. Oh, can you explain this to me? And you start explaining the trade and you realize, wow, I followed all of those rules that I've learned and I didn't even think about it, didn't even realize that I was doing it. That is when you've crossed the Rubicon from somebody who aspires to be a good trader, a profitable trader, a professional trader, to actually being that trader that you've always envisioned yourself to be and that you know you can be. So follow these rules, follow the money. All right, I'm Dan Fitzpatrick, Stock Market Mentor. I'll see you next time.